Hey guys, Dave Keller here with Market Misbehavior. How can you define the trend in the financial markets? Today I'm going to share with you the backstory to my own market trend model. We'll talk about multiple time frame analysis, how we're able to define the market trend on 3 different time frames: the tactical, the cyclical, and the secular, what those time frames mean, and how we can use that chart to navigate some uncertain times here in February of 2025 and beyond. Before we get to my market trend model, how it's derived, and what it can tell us about conditions here today, there's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions, and when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koyfin. Koyfin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koyfin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koyfin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so we're going to talk about multiple time frame analysis today, and we're going to use an example of Apple just to get things kicked off and make sure we're all on the same page here. Basically, when you're thinking about how the market is trending, moving averages are a sort of an obvious way, I would argue, to strip out the noise of the day-to-day movements in a particular stock or ETF or in the broader indexes, as we do with our market trend model, and focusing more on the trend over time. Because the day-to-day price action can be quite noisy, but by focusing more on the trends and how they're changing over time, we can better understand the movement of prices as opposed to just the value of a stock at a particular point. Now, moving averages obviously can have different time frames. So here we're looking at the daily chart of Apple over the last couple of years, and we have the 50-day moving average in blue, the 200-day moving average in red. And the 200-day moving average, the most common that I've seen in many years of working with institutional investors down to individual investors and everyone in between. Most people kind of aware of the 200-day moving average if they ever look at a chart. The 200-day moving average is great in that it can help you make some simple assessments of trend. Just looking at the chart of Apple over the last 3 years, focus on what parts of the chart where the trend is going down, right? Where Apple appears to be trending lower. You'll probably find that the 200-day moving average is sloping downwards. Periods where the market is in a longer uptrend and Apple is generally appreciating a price, you probably see the 200-day moving average sloping higher. If it feels like that's not the case, then you're probably just looking at the wrong time frame. So if you're thinking more about some of these shorter term swings, look at how the 50-day moving average is sloping. And you'll see sort of on that shorter term time frame, looking at a couple months at a time, the 50-day sloping downwards captures a downtrend, and the 50-day sloping upwards captures an uptrend. This period right here, kind of 2023 to 2024, it's a good illustration of what I would say as multiple time frame analysis, right? The long-term trend in Apple from the end of 2022 to now the beginning of 2025 has been generally positive, right? Now, we've had periods like mid-late 23, like first half of 24, where Apple was actually coming down. Even the first 2 weeks of the year, Apple pulled back quite a bit after making a new all-time high in December. However, the longer-term trend was still positive. So if you look through most of that period, the 200-day moving average was sloping higher pretty much since the beginning of 2023, with a brief period of going down second quarter of 2024. But for the most part, that long-term trend, as defined by the 200-day moving average, is positive. Now, while that 200-day was generally sloping higher, notice how the 50-day moving average actually started turning higher a little earlier, maybe in February of 23. You can see that the 50-day sloped downwards in August, September, October of 23, sloped downwards in February, March, April, into May of 2023. And so the shorter-term turns, even within the longer-term trend, those shorter-term turns are better defined by the 50-day moving average because it's a shorter time period, so it's focusing on less data and therefore a little more sensitive to short-term fluctuations in price. So by having the 50-day and the 200-day, and by combining those two, saying, all right, the 200-day is sloping upwards, the 50-day is sloping downwards, that probably tells us we're still in an uptrend over the long term, but in the short term, we're turning lower. That's the idea of using multiple time frame analysis using moving averages, using different moving averages with different time frames to define the trend on those various periods. Now, I have a brief slide. I'm not going to go into full PowerPoint mode, but this is a slide that I drew crudely on a plane years ago in a PowerPoint, just trying to illustrate this concept of multiple time frames and how they work. So imagine, we all have a time frame that we are operating on primarily, right? This is kind of our basic investment horizon. When people say, how long do you tend to hold a position? The orange kind of curve sort of should define that investment horizon. For me, it's usually 1 to 2 months, maybe 3 months, a couple months out. So in general, I'm trying to buy things when they start to go higher. I'm generally wanting to sell things when they're no longer going up. And my goal is to identify this orange time frame, or what I call the cyclical time frame. Now, you also have to remember that that orange cycle that I'm trying to follow is also comprised of a shorter term cycle. Remember, like the 200-day moving average and the 50-day moving average, right? So maybe the orange is more of the 200-day and the blue is more of the 50-day. That's where we can identify some of the short-term pullbacks within the long-term trend. So the orange time frame, the cyclical time frame, may be going up the entire time, but there are periods when the tactical time frame or the short-term time frame, couple days to a couple weeks, actually starts to pull back a little bit. I also have to remember that that orange cycle that I'm trying to navigate in the markets is also part of a much larger cycle, what we call the secular trend. And this is where we look at secular shifts in the business cycle, in the economic cycle, sectors coming in and out of favor, and it may take years for different themes to emerge and strengthen and then start to weaken. So I think of my market analysis on those three different timeframes. The reason why we're talking about these timeframes now is because my market trend model, which we'll talk about in a moment, is literally built around these timeframes. So here we can see the cyclical time frame for me is kind of this orange bar, usually about a couple months on average. Now I have a weekly routine that I do every week over the weekend, and I write a report called the Weekly Flight Plan. I do a video and I share it with my Market Misbehavior Premium members because that's my main time frame. That's where I want to focus my attention. I want to share my insights on that primary time frame. But I also, as a reminder, understand that there's a tactical time frame, a couple days, maybe to a week or two. And that's my daily routine is meant to try to analyze that. My market recap show called Chart This, which I do every weekday after the close, is built around that daily routine. I'm basically sharing some charts that come out of my own daily analytical process where I'm not making big picture decisions most likely. I'm just incrementally adding to what I learned from the weekly routine. So the cyclical time frame is comprised of tactical movements. And I want to understand, are we in the upswings or downswings in that kind of bluer tactical period within my time frame of interest? Then I also may want to pay attention to what are called the secular time frames. Secular time frames for me being over a year or two plus out. I have a monthly routine called the Monthly Chart Review, which I also share with my Market Misbehavior Premium members, where I go through bigger, longer-term charts like weekly and a bunch of monthly charts, really focusing on big picture themes and how they're evolving. But I found a lot of people, when they're just getting started with investing, tend to just think oversimplistically, I guess is the word I was looking for, on one time frame. What you have to remember is whatever time frame you're looking at, whether it's a couple minutes or a couple years, there is a longer-term time frame and a shorter-term time frame that you also probably want to think about. So think of your main investment horizon, your main investment goals, look a little larger, look a little smaller, and then you're going to have a good sense of how your time frame relates to some others. So The chart of Apple that we talked about was kind of good for simplistically defining the trend on those different time frames. However, simple moving averages, if you're really trying to define the trend, simple moving averages are very flawed, because what a 200-day simple moving average does is every day is a simple average of the last 200 closing prices. And what happened yesterday and what happened 198 days ago are equally weighted, right? So yesterday, which arguably is a lot more important than what happened, 6-10 months ago, they're equally treated within the simple moving averages. Same with the 50 days, looking at a 50-day window, and it's taking a simple mean, an average of those 50 closing prices. There's no intention to or thoughtfulness to how we're weighting it. This is why on our market trend model, which we'll now share with you, is based on exponential moving averages. Exponential moving averages look at a similar amount of data, they just weight the data much more differently. What an exponential average does, it actually has a certain percentage assigned to the most recent data. So as a result, when a market starts to change trend, exponential moving averages are always going to move more quickly. They're always going to be more sensitive to changes in the trend because they're more weighted to the recent data. A lot of times with simple moving averages, the movement in the moving average today may just be based on a value 200 days ago that's just rolling off, but I want the trend to be focused more on the most recent data. So that's why when I was designing my market trend model, exponential moving averages were most important. So thinking about those three timeframes, the tactical timeframe, couple weeks, the cyclical timeframe, a couple months, the secular timeframe, a couple years, and again, those are generalizations of those timeframes for sure. I found by looking at a weekly chart and experimenting with a series of exponential moving averages, I could come up with a pretty good way of defining the trend on those different timeframes. That eventually turned into my market trend model, which is what I talk about all the time with my Market Misbehavior Premium members. Occasionally on my YouTube channel, I'll refer to this market trend model, but it's really part of my core weekly process of analyzing the trend for the S&P and then a bunch of other ETFs as well. You can see the moving averages that we're using, the 5, 13, 21, and 34-week moving average. And again, exponential moving averages. Why those periods? You may recognize or may not. Those are all Fibonacci numbers. So I was looking for different combinations. I started testing a bunch of different moving averages combinations and eventually settled in on these four as giving me a pretty good sense of what was going on. Now, to create the market trend model, I'm using an indicator called PPO, which is called the percent price oscillator. This is derived from Jerry Apple years ago, who's credited with creating MACD, the moving average convergence divergence, which is based on the difference between two exponential moving averages. I basically used an adaptation of that indicator called the PPO, the percent price oscillator, that does Apple's original calculation with the exponential moving averages, but it uses percentages instead of price value, dollar values. And as a result, it just gives you a much better, more flexible or more consistent reading on the trends and how they're defined. So the long-term time frame for me, the secular time frame, I use the difference of the 21 versus the 34-week exponential moving average. To define that medium time frame, couple months, it's the 5-week versus the 13-week exponential moving average. To define the short-term trend, I just look at the current price versus the 5-week exponential moving average. This histogram that you see basically is what happens to the PPO indicator on stock charts when you set it up in the way that I'm showing, where I can actually look at the trend and how it's evolving. And so if the histogram is above 0, the indicator is bullish for that time frame. If the indicator is below 0, it's bearish. Now, if I could do it all over again, would I make a neutral rating? Maybe. And at times I've wished maybe I had a neutral rating because it'll be noisy when we're in kind of a transition period. However, I went for simplicity when I was designing this. I went for simple comparisons. I wanted consistent, very simple binary results. It's either thumbs up or thumbs down. That's it. I was not looking to get complicated. I was looking to be super simple and consistent. And so that's how I did it. So look at the S&P 500 over the last 5 years, and let's look at each of these time frames, and you can see how similar to what we did with the chart of Apple. This is just using a better combination of moving averages, I would argue, to define the trend on the time frames I was most interested in. The long-term time frame for me turned bullish in June of 2020, coming out of the COVID low. It turned bearish in May of 2022 after the peak and after the trend had gone down. Because remember, the long-term trend is going to wait until there's quite a bit of deterioration first. Turned back bullish at the end of March of 2023 after the 2022 low and has remained bullish that entire period. So basically bullish through much of this period, bearish in 2022, bullish for 2023, 24, and now so far in 2025. So that has told me basically to be long and strong, fully invested that entire period as much as possible. Now, the medium-term time frame for me, though, is the most important because my main investment horizon is looking like 1 to 3 months out on average, right, when I look back at my own trading. So the medium-term time frame kind of lines up the most with how I want to be positioned in the active portion of my portfolio, where it's a discretionary part where I'm really taking different bets. The medium-term model is above zero. That tells me it's a bullish condition. I should be bullishly positioned. You can see coming out of the October 22 low, the medium-term model turned bullish in November. It did turn slightly bearish in December and then in March of 23, but for the most part remained bullish until this period right here when I started to lighten up and take some risk off in August, September, October because the medium-term model turned bearish. In November of 23, it turned back bullish. It has been bullish all through 2024, and again, so far in 2025, first 6 weeks or so, has remained bullish as well. So since November, first week of November of 2023, it's told me basically long and strong, be invested in the S&P. The short-term model is a much noisier indicator, and through 2023 and 2024, even though the other trends were largely, almost entirely in the bullish framework, you can see 4 or 5 times a year the short-term model turned bearish. And those were some of those tactical kind of pullback periods. For example, in 2024, we can see the short-term model was bearish in April, here in June, here in late August, early September, again around Halloween, right there. And then finally, right at the beginning of this year, turned bearish again. But again, the fact that the medium-term model remained bullish basically told me to think of those short-term bearish signals as pullbacks within the long-term uptrend. Just like we did with Apple and looked at the 50-day versus the 200-day, I'm doing the same thing looking at the short-term or the tactical time frame versus the medium-term or the cyclical time frame. As always, though, I want to remember the most important trend for my retirement, for sort of the long-term creation of wealth, would be the long-term model, right? Because the secular trend is really where the bulk of gains are gonna be derived over time. And so, generally speaking, I don't want to fight that long-term trend. And if the long-term trend is below zero, I want to be out of the markets in cash in some sort of income-generating thing, and just wait for that to turn back positive before I would do anything differently. So that is how I think of the market in 3 different time frames. I have a link in the description below for a link to this chart. You are welcome to it. It's part of my Market Misbehavior live chart list, which I host on stockcharts.com. So for free, you're welcome to access that list of charts. I keep them updated pretty regularly. A lot of my work is derived from those charts initially, and so I'll keep them updated pretty regularly with insights, and those are the things I use to evaluate trend and momentum and breadth and sentiment for the U.S. equity markets. If you want to learn more about this technique and how we use it and get more actionable insights about what these timeframes are telling us and how we want to be positioned based on the signals every week, you might want to become a Market Misbehavior Premium member. The weekly flight plan starts every week with this chart. This is how we start the conversation. Then we go through a bunch of other things to think about positioning and overall levels and patterns and signals we might be looking for in a series of stocks and ETFs. If you want to learn more about those premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 20% off your first 12 months on any plan. That's it for now. I hope you enjoyed this discussion about trends, multiple time frame analysis, and my market trend model. I hope you find it helpful, and I'll look forward to more insights in the weeks and months to come using these particular techniques. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.